For exam one of the topics covered had to do with fixed and variable costs. You have to make sure that you do understand the relationship with that. Remember that if it is a fixed cost, the total is going to stay constant, whether the output goes up or down. For your fixed cost per unit, as the output increases, the cost per unit is going to decrease. For variable costs, for total variable cost, what makes it a variable cost is that as the output increases, then the total cost increases. But for variable cost per unit, as the output changes, the variable cost per unit stays the same. So make sure you understand those concepts. So the question here says if output decreases, total fixed cost will remain the same. So just make sure you understand A, B, C, and D for any questions that you may have on the final. Number 2 says that the company incurred the following costs for January and February. Assume the output was 5,000 units in January, 10,000 units in February. Utility cost is a mixed. Remember, if it's a mixed cost, that means part of it is fixed, part of it's variable. It's telling you that the fixed cost portion of the cost is $3,000. And it wants to know what's the variable rate per unit of output for utility. So really what we can do is we can focus on finding the variable rate. The variable rate is going to be the change in the cost as you have a change in the output level. So if the cost in February was 5, cost in January was 4, it gives you a $1,000 change over the change in the units. So you have a 20 cents variable cost per unit. Another way that you could work this problem is that you could just focus on January and say, okay, in January, the total cost was $4,000. Out of the 4,000, 3 of it is fixed. So that means in January you have $1,000 of variable cost and 5,000 units. So if you take $1,000 divided by the 5,000 units, you would also come up with the 20 cents a unit. So that's another way to calculate it. The third question is for the Holo method. This is so for us to be able to estimate cost. Remember, for the Holo method, the first thing you want to do is find the high point and the low point. So you're looking for the high machine hours and the low machine hours. The next thing you want to do is calculate the variable cost per unit. So to find the variable cost per unit, you're going to take the difference in the cost, divide it by the difference in the hours or the units, whatever quantity it gives you. And this is giving you a variable cost per unit. Once you have variable cost per unit, then you can plug into the cost equation and you can find the estimated fixed cost. So what you fill in for total cost is either the total cost at the high point or at the low point. It doesn't matter. In this solution, he's plugged in the cost at the low point. So the total cost in May was $16,500. Set that equal to variable cost plus fixed. For variable cost, your cost is $38.20 an hour, and in May you had 420 machine hours, so that's giving you the total variable cost. And so you're just calculating and finding fixed. So your fixed cost is $456. Now the question is asking what would the least cost be at a level of 500 machine hours. So you're looking for the total cost. You know that the fixed portion is going to be $456. You had to find that using the Holo method. Then for the variable cost, you plug in the variable cost per unit that you calculated and multiply it by the 500 machine hours. So the total cost is $19,556. Question number 4 says we sell one product at a regular price of $7.50 a unit. Variable costs are 60% of sales. Fixed costs are $30,000. We've decided to decrease the selling price to $6 in hopes of increasing its volume of sales. What's the contribution margin ratio when the selling price is reduced to 6? Now, in this problem, they want you to assume that the variable cost per unit does not change. So what you have to do first is calculate the variable cost per unit based on the original selling price. So the original selling price was $7.50. It tells you that the variable cost is 60% of sales. So that means the variable cost per unit is $4.50. So now we want to know what's that contribution margin ratio going to be when the sales price goes down to $6, but the variable cost per unit stays at $4.50. So if you do that, then that gives you a $1.50 contribution margin per unit. To find the ratio, you just divide that by the sales. Okay, so remember your formula for contribution margin ratio is to take the contribution margin and divide it by the sales. So this gives you 25%. So that's why the answer is A. On number 5, it says that the company makes calendars. Information on a cost per unit is as follows. Tells you that the fixed marketing is $13,000, fixed admin is $35,000. Price per calendar is 10. How many units must be sold in order to have targeted income of $36,000? So this question is coming from the cost volume profit analysis chapter. Remember to calculate that. You're basically doing sales minus variable cost minus fixed cost equals the profit. So you're filling in everything that you know. So what you know for the sales price is that it's $10 a unit. What you know for the variable cost per unit is that it's $4 a unit. So your contribution margin is $6 a unit. You don't know how many units, that's what you're looking for. So basically you have 6x minus 48,000 of fixed cost equals the profit of 36. So you're just solving for the unknown. So you want to take the 48,000, move it to the other side of the equals, it'll flip signs, so you add it together. So that's where you come up with the 84,000. And then you want to divide both sides by 6. So 84,000 divided by 6 is where you're coming up with the 14,000 units. Question number 6. Company provides the following data. You have sales, variable cost, fixed cost, expected production, and sales in units. And then it says what's at the break-even point in sales dollars. Now, there's several different ways to do break-even. However, if all they're giving you is the sales and the variable cost in total amounts, which they are here, then to calculate break-even, you have to use the contribution margin ratio formula. And to find break-even, basically your formula is to take the fixed cost and to just divide it by the contribution margin ratio. So ultimately what you end up doing is taking the fixed cost and dividing it by the contribution margin ratio. To calculate contribution margin ratio, it's contribution margin divided by sales. Contribution margin is sales minus variable cost. So that gives you contribution margin of 162 divided by 540,000. So that gives you a 30% contribution margin ratio. We know the ratio is a percentage of sales. So basically you can plug in, you're looking for sales, that's what you don't know. So 30% X minus the fixed cost equals, remember for break even, profit would be 0. Move the fixed cost to the other side of the equals, which is 120. So you have 0.3x equals 120. So you divide fixed cost by the 0.3, and that's how you arrive at the $400,000 of sales. Next question. This is the most difficult type of question that you could have. You're looking for break even, and you're selling more than one unit. So what you have to do, there's a couple different ways you can do this. You can take, first off, you want to find the contribution margin for each different unit. So for the standard, you've got sales price minus variable cost. That gives you contribution margin. Deluxe, sales price minus variable cost, contribution margin. For superior, you have sales price minus variable cost, gives you contribution margin. And then what you can do is multiply it out basically by the number of units. So we sell 8 standard, 4 deluxe for every 1 superior. Multiply that out and then divide it by total number of units, and that gives you the weighted average contribution margin per unit. So multiply it all out, add them together, divide by total number of units. So the units is coming back from here. The 8 plus the 4 plus the 1 gives you 13, and that gives you $230.77 is your weighted average contribution margin. Another method to calculate weighted average contribution margin is instead of multiplying this out by the number of units, you can multiply it out by the percentage. Okay, so you can multiply it by the sales mix. So the sales mix for the standard is 8 divided by 13. So you can do 150 times 8 divided by 13. For deluxe, you could do 200 times 4 divided by 13, and then 1,000 times 1 divided by 13. Then add up what you get, and that will also bring you to the 230.77. So either way works. There's a couple different methods. Once you find the weighted average contribution margin, Then you can find the break-even point. So to do that, you have your weighted average contribution margin minus the fixed cost equals break-even, which is 0. So move the 300 to the other side of the equals. So you end up with 300,000 divided by 230,000.77, which gives you the break-even units. For the break-even units, it would be 13,000. And then to calculate sales revenue, you can take the break-even units, break it back out by how many are standard, deluxe, superior, and then you have to multiply it back out by the sales price. Or in this case, what they've done is taken your average sales price per unit. So you're basically doing it the exact same way you found weighted average contribution margin. Your average sales price is $498.46. Multiply that out, and you can come back to the $648. Number 8, the company invested in a project with a payback period of 6 years. The project brings $18,000 per year for 9 years. What's the initial investment? Remember, your formula for payback period is to take the investment divided by annual cash flow. So we're just reversing into that. We know that we're going to pay back the initial investment in 6 years. We know that it's bringing $18,000 per year. So if you take how much annual cash you got times the payback period, that's going to give you your initial investment of $108. For the next question, we're looking for the net present value of the investment. Remember, for net present value, what you're taking is your cash flow and you're multiplying it by the present value factor. The present value factor is what's on the table, which will be provided to you, obviously, and then subtracting from it the initial investment. So to find the present value of future cash, your annual net cash inflow is $25,000. You're getting it every year for 10 years, so that's an annuity. So take the annuity table, timeline 10, 4% to get the present value factor of 8.111. Multiply it by your annual cash flow. That gives you the present value of all the future cash. Subtract from it the initial investment, and that leaves you with your net present value of $2,775. 10, a firm is considering a project with an annual cash flow of $80,000. The project would have a 10-year life. We have a discount rate of 8%. What's the maximum amount the company would invest? If the question is asking you for the maximum amount that you would invest, what you're looking for is the present value of that future cash. Okay, so again, to find the present value of the cash, you're taking the annual cash flow, multiplying it by the factor. To find the factor, it tells you you're getting $80,000 every year for 10 years, so it's an annuity, timeline 10, 8%, so that's a factor of 6.710, multiplied by the 80, so that's giving you the present value of $536,800, so your answer on 10 is B.